Welcome to The Other Side of the Table with me, Tom Frogger. Raising money in biotech, tech bio and life sciences is crucial and complicated. In this podcast, we'll sit down with specialist investors to understand how they see the market, how they assess potential deals, and the mistakes they see time and again that you can avoid.
I'm back on the other side of the table, and I am delighted to be joined by Hanadi Jabado of Sana Capital. Hanadi, welcome onto the show.
Thank you very much for having me, Tom. It's a delight to be here with you.
Yeah, and you. So we always start, Hanadi, by getting a view on the market from the people that we speak to. And we are recording this on the 22nd of February, for context. In UK biotech and biotech more broadly, where do you feel we are from a market perspective right now?
So the year is very important. The year is 2024, 22nd of February, 2024.
True, yes.
We are not in 2021 or 2022. So in 2021, as you may have heard from many people, we had a bit of a bubble. Specifically in the healthcare, biotech, health tech market. With COVID, a lot of people have put a lot of bet on health, on biotech, and 2021 was an amazing year for everyone. 2022, we started to see a decline, and people were saying, "Oh, it's going to get better in 2023." I told the companies I've invested in, it's going to be a long journey through a very dry desert, and I don't expect anything to get better until 2025.
Okay.
So, February 2022. Things started going down. February 2023, there was no hope of things getting better. And now in February 2024, people are telling you, "Oh, I can see the light at the end of the tunnel." I genuinely wish that one can say they are seeing the light at the end of the tunnel. I think it's not going to be until Q2 of 2025, potentially Q1 of 2025, that we're going to start to see the light at the end of the tunnel. I'm sorry to be, coming here as an angel of doom and gloom.
No.
But I think that it is quite hard at the moment across sectors, but even in the biotech sector.
Yes. And why that timeline, do you think? Why do you think sort of the first half of next year is potentially when it might start turning around?
People do not like uncertainty. And there is, at a macro level, a lot of uncertainty. There is a lot of uncertainty in terms of the geopolitical situation.
Yeah.
Going back to the year 2024, it's going to be a big year in terms of elections.
Yes, of course.
And investors are sitting back. And by investors, I don't mean VCs. I mean, remember that VCs do fundraise themselves and have to go with their begging bowl to other investors. And those investors are called LPs.
Yes.
And the LPs who invest in the VCs, who in turn will invest in the biotech, are being very cautious and seeing what's happening on both sides of the pond. And whatever government will come in will be some kind of certainty. And then I think they will start to see, okay, for the next 4 years, on one side, this is what we're going to have. And on the other side, this is what we're going to have. And start releasing funds. But I don't see major changes before we have that certainty.
Yeah, I see. And I suppose that's easy to forget, right? That you have to raise money too. And I suppose whether it's sort of institutions or, wealthy individuals or what have you, that in most markets at most times, having active money is better than having passive money. But I guess there are different risk calculations being done right now about how active they want their money to be, I would suspect.
Well, yes and no.
Mhm.
So define active. There are some safer investments,
Yeah.
such as real estate and traditional. So a big LP class is family offices.
Right.
Traditionally, those family offices will invest in real estate and traditional sectors, and those yield, conservative but comfortable returns. So their money is still being active.
Mm.
And there is too much uncertainty around what's happening with early stage companies and even, I'm talking about early stage, anything from pre-seed, seed, all the way to Series E
Yeah.
still is considered as early stage. So and when you have interest rates as high as they are currently, you can get a guaranteed 5% just by depositing your money somewhere.
Right.
So why trust a hooligan like
Mm.
me with your capital?
Yeah, no, I understand. And I suppose as well, I don't know, my sort of take on this is along with the macroeconomic factors and the global sort of political factors and all the things that you've mentioned, we sort of saw the biotech market just get a bit carried away over a course of a series of years, right? And there's a reaction to that that's also coming through in that, now people are having to raise down rounds, flat rounds, this sort of stuff just to survive.
So yes, so in 2021, everything was getting funded,
Mhm.
and everything was getting funded at silly valuations. I remember in 2021 looking at deals and saying, I can't do this deal
Yeah.
simply because I cannot make the numbers work. And I cannot put my name, I can't put my risk behind that kind of valuation. I also have seen stuff getting funded going, wow. You hear about FOMO, but at
Mhm.
that stage, I discovered JOMO, the
Yeah.
joy of missing out. I was like, okay, I don't understand why you're getting money. I don't understand why you're getting funded. So you're right. There's been a market rectification in the sense that stuff that shouldn't have gotten funded had to die.
Yeah.
And stuff that got funded at silly valuation had to get a reality check.
Yes.
Now, good companies have looked at the downturn, and instead of waiting for things to get better 6 months down the line or 12 months down the line, have been looking at a reality check. And they've done a reality check first by saying, okay, we've raised that much at a really good time. People are saying it's going to take 12 months for the markets to get better. Let's say it's going to take 24 months.
Mhm.
So, how can we make this money last longer while still building value and growing? Let's take a look at our growth plan. How ambitious is this? How realistic it is given the current economic environment? So,
Yes.
good companies have made those adjustments,
Yes.
and they have made their money last longer. They also have gone and talked to clients, you know, and gotten procurement money, which is even
Mhm. Mhm.
scarier than getting investor money, and have revised their plans. So yes, there's one category which, it's Darwin. They were doomed to extinction. They moved on to extinction. Second category, they had to face a reality check and either flat round or down round. And then you've got the companies that actually were proactive and
Yes.
have proactively managed their cash and also proactively changed their ambitions and their growth plans to
Yeah.
match the resources available.
Yes. Yeah, that makes sense. And acting early in these situations is critical, right? Every day is expensive for these companies. So yeah, understand. And so with all of that in mind, how I assume, and correct me if I'm wrong, I assume you still look at investments, you're still considering investments, you're still talking to companies that come through. With all the factors that we've talked about, what now makes you sit up and take notice? What do you look for in an investment now that's either sort of consistent with what's always been the case or is different given the market?
So I think it's still the same. It's a really I've never the strapline at Sana Capital is capital to heal the world.
Okay.
So it's really not a modest ambition.
Yes.
So I really want to move from talking about patients to talk about people.
Mm-hmm.
And what really motivates me, what still strikes my my burning desire to help and to get involved, is companies that are finding radical solutions to improve people's health, not something marginal. So I've never been interested in apps. I've never been interested in, gadgets, and I really, so really big ambitious companies is always something that really made me tick. I also get a lot of buzz. So one mistake that people make, they forget that investors are humans.
Mm-hmm.
And we are people, and people invest in people.
Yes.
And population of the world is over 7 billion. You can't click and gel with everyone.
No.
So I like ambitious founding teams and senior management teams. I like people who are coachable. Coachable doesn't mean people who are puppets, I like people who take advice, listen, and then make up their own mind. I like people who seek advice, and who analyze, who listen, and act on it. And I like people who are hungry. And finally, I like people whom I can trust.
Mm-hmm.
So I need a big picture, big ambitious picture that's gonna make a significant impact on the world, not something incremental. A really passionate, coachable, mature senior management team with whom I'd have chemistry. And then last but not least, I'm a data geek.
Okay.
So anything that combines data really rocks my boat.
Yeah.
I think that today we are in a unique position globally to capture a snapshot of the health of humanity.
Okay.
And I think, data is really key. But right now, data is fragmented, badly curated. Ownership of data is not clear. So I'm a platelet donor. I donate platelets. My children are blood donors. And I think the future is not just blood donations or platelet donations that's going to save life. It's going to be your health data donation.
Yeah, I see. Okay. Yeah, because the amount of insight we can gather is significant now, right? But there's so many different languages we're speaking from a data point of view, and so many different ways, and I guess there's so many different aspects to biology. If you just look at all the different types of omics data that can be gathered, how do you make those speak to each other? And there's a real challenge in that, isn't there?
So people keep on telling you about the rise of machine learning and AI, right? Machine learning and AI has been there for a very, very long time.
Yes.
What has changed recently is the power of computing, but also, and most importantly, the data available. Everybody has an algorithm, and everybody has a secret sauce, but actually, it doesn't really matter. What really matters is the data that you have access to, the quality of the data, the curation of the data, and a word that I've always felt to pronounce, but that is so key: the heterogeneity of the data.
Right.
And all of this is really crucial. So companies, startups that have access to health data, and are able to take the data that's coming in all the kind of format with all of the rubbish that is associated, and able to clean it and organize it, and then have amazing data sets to put through the algorithm. Those are the companies that are going to bring better health globally.
Yeah, I see. Okay. And so is it just a case, so those are the principles you've always operated on from what you've said. Is it a case then that the thing that has changed now is how you would value those businesses, or is that still the same as well?
So no, I try to be fair.
Okay.
So I try to be fair. I mean, I was tough on valuations, 5 years ago. I haven't changed, but I want to be fair. So I know that you have horrible stories about VCs waiting for the markets to go further down. For me, valuation is only one term.
Yes.
And there are so many other terms that are so much more important as part of the package. And it needs to make sense across. So I don't think so in 2021, I passed on deals where I liked the teams.
Yeah.
I like the mission. I like everything, but I just couldn't bring myself to pay that price, that inflated price.
Yeah, I see.
So I would always pay a fair price. May I give you an example?
Yeah, please.
So about 2.5 years ago, 3 years ago, there was a company that came on my radar. I loved the founding team. Amazing founding, women founder, two co-founders, so mixed team. I really liked the scientific rigor, the coachability, the chemistry, and worked with them quite well, and was going to join their round. And the valuation was a bit punchy.
Yeah.
But I was not going to haggle. It was a big mission, something completely new. I love making science fiction
Yeah, I
facts,
see.
science facts. I like translating science fiction into science facts. And
Uh-huh.
that was really one of those companies where you really were taking Star Trek type and turning it into your daily reality.
Yeah.
So what was there not to like? And I wasn't going to haggle on 2 pennies. And then founder rings me and says, I'm in a bit of a conundrum. Um, Somebody's come and offered me an uplift in the valuation of almost 75%.
Wow.
I would love to have you in, but I would understand if you didn't follow. And I said to her, good on you. I'm not going to stop between you and this amazing
Sure.
valuation, but I cannot. It doesn't make sense to me.
Yeah.
So very happy to keep on talking, very happy to keep advising you, but I can't do this. And she said, I understand. And then she went quiet. And 6 months later, she calls me, and surprise, surprise, markets had dropped. The whole world was coming apart. The investor had done expensive due diligence that they left with the founders, signed
Right.
investment documents, but decided at the last minute not to proceed with the investment. And they were left with 2 weeks runway.
Yes.
I jumped in
Yeah.
and brought together a syndicate, and we did the round at a fair price, not
Yeah.
at the 75%.
Yeah.
And we managed to move quickly enough to actually save that company, and make sure that everybody had a good Christmas. So if it's too good to be true, it's probably
Yeah.
too good to be true.
Yes. It's very easy to say a number, isn't it?
And but it's harder to follow through.
Absolutely. Yeah. Yeah. No, that makes sense. Okay. And you mentioned something earlier that I thought was interesting, because it almost seems a given, but you particularly called it out, the idea of trust, finding founders you can trust. That's hard though, right? It's hard to assess sometimes, and I guess you have a window in which to assess that. But is it more about looking for things that put you off trusting someone, or how do you, because that's, as you say, it's something that's got to be critical, right? Because you're giving a good chunk of money away to someone who you're not going to see every day. You're not going to see, or you've got to trust that they're going to do the right thing with it.
So a couple of things on that. So first and foremost, I never give money away.
Apologies. Yes.
No, it's really important. Okay.
Yeah.
They're not charities, they're in investments.
No.
And just like I hate it when founders say they're giving equity away. You're not giving equity away. You're selling your equity.
Yeah.
And more importantly, you're selling a big chunk of the risk.
Yes.
You're selling your vision. So it's a transaction, right?
Yeah.
So in theory, you should be able, specifically at the early stage where I operate, at pre-seed, seed, Series A, you should be able to do a deal really quickly, 2 to 3 months, to get the paperwork and all of that. Why does it take 18 months?
Yes.
It's like dating. You really need to get to know people. You need to get to know the business. You need to get to know um, where they're going to. It's not just number crunching. It's not just, SWOT analysis and all of that. It's just, how do people respond to challenges?
Right.
How do people really respond to challenges? How do they take your advice? How do they, everybody looks so nice and proper, but how are they going to behave when you're stuck with them in a board meeting for 6 hours, and you know that there's very little cash left in the bank, and you need to make some difficult decisions? So this can only happen by having regular contact, working with them. And I'm a conviction investor, and I try and add value by joining the board,
Right.
or either an observer or as a director, and roll up my sleeve and work with the companies. So there's work before, but there's work afterwards. And it's really important to understand that trust is a two-way mechanism. So I need to trust them, but they need to trust me.
Yes.
And it's, if I can trust them and I feel that they don't trust me, I will not do the deal, because I won't be able to operate. And I know it sounds really Peppa Pig, and I'm not Peppa Pig. I'm very pragmatic.
Yeah.
I don't have much of a filter, and I say things the way they are. So, there aren't many layers, and there isn't many, if people do not trust you, it is much harder to work with them, to coach them, to get them to see. I'm older and uglier than much of the founders I work with. I've got all the scars. I've seen it all. There's still stuff that happens that still surprises me, but
Of course, yeah.
But for me to be able to convey my experience, they need to be able to trust, and they need to go past seeing the evil investment director that is only acting on behalf of their own investment.
Yeah.
And they really need to see that we are actually all on the same boat, rowing together rather than against each other, and trying to go in the same direction. So trust is a two-way street.
Yeah, absolutely. No, it's interesting. And it's good to call that out, I think. So this may combine a couple of questions, really. I always tell people not to ask double-barreled questions, but I'm going to do it anyway. You have seen many pitches over the years, and I know have done your own, and this is an area you're very familiar with. So I guess, what are and we may have touched on some of them already, what are the common mistakes that you see people making? And as a follow-on from that, what advice would you give to those who are out raising money in what is a challenging market right now, and so need to be really sharp about it?
Okay, so I'm going to tell you about the most common mistake that no one talks about.
Okay, that'd be great.
You've got founders who deliver an amazing pitch, and that's it. That's their pitch, and then their Q&A, and they lower their guard, and they forget that actually the pitch is not over.
Right.
They're still pitching, specifically in the Q&A.
Yes.
And then the pitch doesn't stop just there. It carries on in the follow-up and in the challenges that your investors send you, the feedback, the additional questions. And it's all about that due diligence and that trust building and that testing of how people are reacting. So most common mistake is to think that the pitch is that, pitch deck that you take your investors through and dazzle them with, and that's it. And then you lower your guard.
Right,
and then so it carries on. It carries on in the Q&A. It carries on if you're doing this in person and there are drinks afterwards. There's no such thing as an informal chat with an investor.
Yeah, okay, that's a good point.
Right. So that would be the second mistake is really to forget that investors are people.
Yes, you mentioned that.
And people invest in people. And, investors have bad days. Investors have, childcare issues. They may have issues with their own investors. So if you see your investor on the other side frowning, or don't let it throw you off. It may not just be you, it might be something else. And just, connect with your investors at a human level. As an investor, you see about anything between 1,000 and 1,200 decks a year.
Right, yeah.
And then you will select 40 that you'll dig in. And probably you'll do, depending on the size of the fund, 5 to 10 investments a year.
Right, yeah.
So there's quite an attrition rate.
Absolutely.
If your investor is taking the time to give you some feedback, do thank them. Right? Do follow up with them, stay in touch, because they may not be the right investor for you, but they can make introductions.
Yeah.
They can give you advice, and they're more likely to do so if you have thanked them and you have built that relationship and you've kept them abreast. And I may not be the right investor for you today, but I might be the right investor for you 5 years or 10 years down the line. So stay in touch, keep me appraised of your development. And, out of 10 pieces of feedback that I would give, 7 would not reply. If it's a no.
Oh, really? Okay.
7 would completely ignore it. 2 would say, thank you, I really appreciate it. May I please stay in touch? And they usually don't. And then half would say, amazing advice, thank you so much. And half would say, you're an idiot, you didn't get it, and I'm going to prove you wrong. And you know what? I like the 2 halves and the 2 twos, even if they don't stay. It's you'd be surprised by how many of the 7s reappear in my radar, and
it's a very small world.
It's a very, very small world. It's I was on a panel at a conference in London, and one of the stars of the show was this very successful entrepreneur pitching a health tech. And she came to me at the networking and she said, I've been trying to get an introduction into you forever. I would love to pitch to you. I said, oh, you did pitch to me 2.5 years ago. And she goes, really? I said, yeah, I did.
Okay.
And she looked it up, followed up by email and said, yes, I did. And I never followed up with you, and I'm following up now.
Oh,
So,
well.
but it's fine. She obviously made an impression. I didn't make an impression. I'm used to it. Don't worry.
Well, you know, those metrics that you mentioned earlier are interesting, because I think that's again something that perhaps people might not have an appreciation of, is how many of these decks that you see, and the attrition rate of those necessarily, right? So it's only 0.5% to 1% of the opportunities that you see that you'll eventually pursue. So in terms of that sort of initial spark of interest, is there anything you'd recommend to get that, to get that sort of just further look? Because of course, if you get that further look, there's a much higher chance that that's going to convert to a conversation, right?
If the deck is sent to me by someone I trust,
Right.
they'll get that further look.
Right.
And again, I think there are two things. I have invested as an angel investor, and the only people you need to convince are my children.
Right. Yes.
Right. So basically, I like it. I want to do it. I'll run it past my children and say, what do you think? And then the decision is mine, and it's my money, it's my risk, and if I want to give away, to use your words of earlier,
Yes.
Apologies. No, but sometimes it feels like it's so far-fetched, but it's my money, and maybe and I'm quite honest in saying, this is not for me. It doesn't rock my boat, and I can say that quite now. As a fund, it's completely different.
Of course, yeah.
There's a team. It's a team decision. It's not just me. There are people involved, and then there's an investment committee. And remember, I have made, well, not just me, all investors, all VCs have made promises to their own investors.
Right.
Right. And we need to return investments, and we cannot invest in anything that is outside of our investment thesis. And we write our investment thesis way before we have the money in the bank. In a fast-moving world, there is so many interesting things that are there today that we didn't envisage would be there 3 or 5 years ago.
Right.
So it's not just you. Sometimes it's about us.
Yeah,
And when we say, really, it's not about you, and there's nothing wrong about you. And so the advice you were asking me about, advice for people, I think that one of the advice is I would look at, I would always see the pitching as a two-way pitch.
Okay. Yeah.
Right. You also need to see whether you would like that investor on your cap table. Are they adding value? How do they behave when the shit hit the fan?
Yes.
How do they behave when things go wrong? And things can go seriously wrong. They will take references on you. Make sure you take references on them, but don't ask them for references for companies that are, where everything is rosy, but ask them for references with companies that have gone bankrupt or that are not so good. Because it's when things don't go well that you really want to know how people have behaved. So do take references. So that would be my key one. Make sure that they are going to add value, that it's not just on money. Make sure to not go back to your investors only when you want money.
Right.
Your fundraise every 2 years. Keep them part of the journey, keep them excited, share your sorrows, and just as well as share your joys, because it's important that they feel invested, not just with their money, but also with their emotions, and feel part of the success of the company. The money is not raised until all of the documents are signed and the money is in the bank.
Yes.
Right. And be realistic about your expectations. And finally, do not obsess about the valuation. Valuation, this is the rookie mistake that I see 9 times out of 10, even with experienced founders, where they obsess on the valuation.
Yes.
The valuation is only one term of a very complex transaction.
Yeah. No, I see. And it's also not the point, right? It's about enabling the mission as much as anything else, and the valuation is important, of course, but yeah, I get what you mean. There's a little bit of myopia around that.
I think it's because there's so much romance around the valuation. And when people talk about raising money, they say, I've raised X at that valuation pre-money. They don't talk about the other terms.
Right.
So for people so it becomes, the one KPI that everybody wants, and the higher the valuation, but actually there are many others that are so much more important. And oftentimes founders do not understand that they can negotiate the terms. They think that they can only negotiate the valuation.
Valuation, yeah.
But actually, this is not the case. Everything is up for negotiation.
I think that's a fabulous point to end on, Hanadi. Thank you so much for the insight. It's been brilliant to talk to you, and thank you for taking the time.
Thank you for having me. It's a real pleasure.
Thanks for listening. Outside of hosting podcasts, I'm the CEO of a company called Singular. We work with biotech businesses from seed to Series B to help them build a brilliant culture that delivers on their milestones. Come check us out at www.singular-biotech.com, and I'll see you next episode.